Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. After popular demand, we had requests to bring back a popular guest. She is a petroleum engineer for many years, working at Chevron, Hess Oil, and Schlumberger, and also a private investor in oil and natural gas stocks. Christine Guerrero, thank you for joining me again.
Yeah, and thanks for having me back on. It's always an honor to be asked back because you didn't completely blow it the first time.
Well, I think you gave our listeners a ton of really great analysis of deepwater offshore Guyana and Brazil and some of these other Gulf of Mexico plays there. And we're going to talk about some of the recent stuff happening in Guyana now with the Venezuelan military, which doesn't really have a great reputation there for conquest lately. You were telling me before we started recording that they have some funny nicknames in the oil industry there. I'm not sure if we want to say it publicly, but we'll talk about that later because the narrative going around with the oil industry, the narrative going around right now is that Venezuela could potentially invade Guyana, and I want your thoughts on that. But first, let's talk about big picture, the oil supply and demand fundamentals. So these hedge funds, and a lot of them are very short-term oriented. They're not specific oil and natural gas investors. They're global macro people, and they're very short-term, monthly or quarterly. The narrative for the hedge fund managers is that the global economy is going into a recession. There's an oil supply glut here in the United States, and that demand is collapsing. You just put out a nice slide deck for investors. Do you think that these narratives are true of what the hedge funds are saying?
So the big fear right now is China demand. So it really doesn't take a whole lot of excess supply or under demand to really move the market, because it's small volumes that can create a big spike or a big depression in oil price. And what's happened is in the third quarter of this year and into the fourth quarter, we've seen the demand from China slowing down, and it's expected to stay slow through the first half of 2024 and then pick up in the second half of 2024. And that is what's creating the fear in the oil market right now, and the weakness that recently pulled us down to like $68 last week. So it's really, these small nominal shifts, that are occurring in China more so than any other place in the world.
So that's the demand fluctuation, because I mean, the demand earlier this year in 2023, and we're recording this interview on Wednesday, December 20th, 2023, for our listeners out there, because I always get asked the date, and we've had a little bit of a rally in West Texas Intermediate. Like you said, it got down to the high 80s, I think, last week, a little bit of a rally there.
Yeah, it got down to like 68, and then it crawled back up to like 73, 74 now. So
well, in your slides, hasn't Indian demand and other emerging market demand, it's actually surprised to the upside, though. So there's actually been some demand growth from non-Chinese emerging market type countries.
Yeah, but really it's China and India where the majority of the growth in demand is coming from. So those are the regions that the market's laser focused on, because just because of the scale of those countries and what they're needing to import. So whereas a lot of the other countries are more balanced. And really, like when you start having discussions with people, I mean, it's really just China, China, China. So when you hear people talking about China slowing down, I mean, that's in September, we were like $95 a barrel, in Brent crude. And then we dragged, all the way down to 68. I mean, that was two factors. It was weakness coming out of China. And then it was also that U.S. production hit an all-time high in September. So U.S. production grew this year like far beyond anyone's expectations. So potentially even more than the weakness in China demand. That extra production from the U.S., in my opinion, kicked the market off balance.
So Josh Young, I interviewed him again. He's an oil hedge fund manager. I know you're friends with him. I interviewed him again a couple weeks ago. He was saying that there was a huge increase, and he thought it was a one-time increase in Bakken shale oil production. There was a big restart over the last like 6 to 8 months. Do you think that that's sustainable, or do you think that that's going to sputter out too?
I don't really think it's the Bakken. I think what's happened is coming out of the Permian. So, and I was kind of caught off guard by this as well, because I get all of my insights, from publicly available data, and then quarter after quarter I'm listening to the company's report, and they're giving me indications of whether or not that trends that I believe are following through, or are changing. And one thing that we saw in the third quarter of this year was that the rig count in the Permian for the public companies had more or less stayed flat all year. But the private companies, who we don't have a lot of insight into, this entire year they were actually dropping rigs. I mean, they dropped, like a third of their rigs. And so what had actually happened coming out of COVID in 2020 was the private operators had started picking up rigs at a much higher, more accelerated rate than the public companies do. And that's because, like, private companies, for the most part, they don't have to suffer from the winds of shareholders and banks telling them, we want you to do this, and we want you to do that. Like, private companies have a lot more flexibility on their annual budgets, whether they're going to increase them mid-year or scale them down and things like that. And so basically, when we started coming out of the COVID crash, the private companies were cranking away much harder than the public companies. And they did that for 2 solid years. And they actually grew their Permian production to be greater than the public companies' Permian production. And they actually started outpacing the Permian, the public companies' production. Let me see if I can find the information. I want to say sometime in 2021, and up until now, they have been outproducing the public companies. But because this year they have started reducing the rig count, we're actually starting to, just now, it looks like the Permian output is starting to slow down a little bit and go down. And I think that is that we're finally starting to see the lag of the drilling activity that has been reduced by those private companies, all this year. And then when you talk about shale, you also have to talk about DUCs, the drilled uncompleted wells. So last year there were only about 200 DUCs completed. But this year there were 1,000 DUCs completed. So again, you see that they were, really aggressively, bringing these wells on. And I think that's because these private companies were more so trying to dress themselves up to be bought. And there's really like 9 private companies, I mean, that drove the majority of the production growth in the Permian. And of those 9, 3 of them have been acquired. The deals have been announced like in the last month. And there's a 4th that is currently marketing itself right now. So as these big private companies get acquired, it's actually really good for the oil market point forward, because the public companies that are buying them, they're much more cautious, and they're more steady with their programs. And so they're not just going to be ratcheting up and ratcheting down on whims. It's going to be more of a slow and steady growth that helps the market, so we don't see these whipsaws in crude, which we've really experienced like this whole year now. I mean, it was actually really funny, because I think like last week, Bloomberg had a slide that came out on one of their articles, and the slide says oil prices holding steady, though demand concerns linger. And I'm like thinking to myself, holding steady. I'm like, crude was $77 at the start of the year. Then it dumped to 65 in March. Then it rallied in April, only to fall back down the following month into the 60s, and it hit the 60s in May and June and in July, which should have been like the hot driving season for the US, and then finally climbed up to 95 in September, only to crash like another 28% to 68 2.5 months later. And then now here we are and back at 74. So I don't know about you, but to me, 30% swings in price doesn't feel steady.
Yeah, it's a roller coaster. I mean, the headline writer at Bloomberg, I mean, most of those guys they probably hate oil. They're probably like pro ESG people. So the bias in the headlines and stuff like that, it's not going to analyze the market as someone who worked in the oil industry or an oil and natural gas investor trying to be a little bit more objective. You brought up some really interesting points. So how much do you think interest rates have affected then oil production growth in the Permian Basin for some of these private drillers?
Well, I don't think it's affected it up until now, because obviously they were accessing just as much capital as they wanted in order to scale their production. So if we go back and if we look at the recent years in the Permian, so if we go back to the beginning of 2020, the private operators have actually increased their production by 31%. The majors only increased their production by 8%. And independent companies are actually down by 2%. So in my opinion, that's pretty much flat. So privates having increased their production by 31%, I mean, to me, that clearly demonstrates that they had no problem getting a hold of money.
Well, don't you think that eventually they're going to hit the wall with depletion for production growth? So they're not going to be able to keep growing oil production, especially with interest rates at these levels, cost of capital higher, and then the sheer depletion of these shale oil wells that they're drilling after like 2 or 3 years, right? They're going to deplete. They're not going to be able to replace that production growth nearly as quickly going forward.
Well, they're trying to get out. So the privates right now are trying to liquidate by selling their remaining their wells and their remaining drill sites to majors. And majors, because they haven't done enough exploration over the previous decade, they're kind of in a position where they have to buy these other companies because that's how they get their reserves replacement. So, even though these wells decline, by like 50%, within the first year, I mean, they're still going to be trickling out free cash flow for years to come, just not at the rate that it was at the very beginning when the well came online because of these exponential declines. But you're talking about thousands and thousands of wells. So, I mean, it still adds up to money. And then they do still have undrilled acreage. So,
Is
they're
that undrilled? Sorry to interrupt you. Is that undrilled? Is that tier 1 or is that not as good tier 2 acreage then?
Well, that's to be seen. I mean, it goes without saying that tier 1 acreage would be less and less each year, because a company isn't going to drill their tier 2 first. They're going to drill their tier 1 first. So like I haven't looked at seismic plans and like dove into these companies' data rooms and things like that to actually see how much tier 1 that they have left. I mean, obviously, Exxon believed that they were getting an excellent deal in buying Pioneer to think that they could continue to scale production above what Pioneer was already producing. But all of that, is to be seen. I mean, I felt like their assumptions that they were going to increase production are like beyond what Pioneer was already doing, because Pioneer was already excellent at their well completions and their well designs, and we're kind of already a tier 1 in operational excellence. So to go beyond, above and beyond that, I mean,
overly optimistic. You're saying
good luck
Exxon.
ExxonMobil. Good luck Exxon.
Yeah, I've had a number of people say that like they overpaid for that acquisition, but they needed the land package though to justify. So they needed to go buy something big with potential some remaining tier 1 acreage.
Yeah. So like again, it's all reserves replacement, and it's like, hey, why go buy 20 small companies when you could get it all under one? So, and I mean, and who knows? I mean, they probably have some big investment interest that are parties in, both companies that were pushing for the deals. So, we just don't know everything that goes on behind the scenes. But I mean, clearly Exxon is a major for a reason. And, whether or not their expectations are achieved through this acquisition. I mean, if oil stays above 80 for the next decade, it won't be a problem. So.
Well, if they bought the smaller companies, and I was talking about this with Josh, they would have gotten lower cash flow multiples. So they would have gotten better valuations on the deal. So you've been seeing some of the smaller players, I think, Permian Basin oil production, if that's the name correctly. So some of the smaller operators have been buying, consolidating these smaller Permian Basin companies at 2 to 3 times cash flow. I think Occidental Petroleum just put in a bid for one company, and Warren Buffett says that he's buying more shares at Occidental. And then I think there was one of the Permian Basin or Round Rock or one of the other ones. So they're smaller ones, but the smaller ones are being more efficient and paying lower cash flow multiples than what ExxonMobil did.
Yeah, but it's also most likely because their acreage isn't as good. So, I mean, you got to think about the history of these companies and how they get their acreage. They all go bid against each other. So most likely the bigger small companies have better acreage than the small companies. You know what I mean? So the mid-sized companies like the pioneers, if they wanted to go grab acreage and they were vying against, like, let's say a Vital Energy, for example, who used to be Laredo. I mean, Pioneer would always be able to outbid Laredo, because the bigger you are, the more strength you have. And actually just today, there was even a Gulf of Mexico lease sale. And when you look at who spent the most in those sales and which blocks went for the most money, they didn't go to small companies, they went to majors. Because it was majors who were able to turn around and say, okay, U.S. government, I want to pay $69 million for this block. And that was the highest bid block. I think it was $69 million, and that was a shale block. So versus other fringe blocks might have only went for $500,000 or $1 million. So just to get access to that, even from the beginning, you got to have money to make money. So
Yeah,
that also kind of speaks to the multiples, right? It's like higher quality companies have higher quality acreage and they have better multiples.
Well, also during the last oil bear market in 2015, 2016, when the oil prices went down, when the shale bubble was in full ramp up production mode there, growing production at losses, a lot of those smaller independent deepwater offshore producers that have some of that lower acreage, I mean, they were going bankrupt. So, I mean, like that part of the industry is not going to get as much capital. I want to ask,
Gulf of Mexico.
Hmm?
Actually, Gulf of Mexico right now. I mean, there's still a lot of interest in it, but it's slowly being turned over to private companies. So, but the Gulf of Mexico doesn't produce as much as the Permian. So the Permian Basin is, clearly the number one basin within the U.S. right now. But still, I mean, the Gulf of Mexico is nothing to like thumb your nose at, because it still produces a ton of oil and it's highly valuable. And when you look at the two companies that produce the most oil out of the Gulf of Mexico, they're not even U.S. companies. They're Shell and BP. So clearly our neighbors across the pond highly value the Gulf of Mexico. And it's also because it's lower carbon than these shale plays, and the wells last longer. They're conventional wells. They're pressure driven, and you don't see the volatility on the production profiles, coming out of these offshore deepwater fields. So the deepwater, the U.S. Gulf of Mexico has actually been climbing. The deepwater portion has been climbing each year 10 to 15% on average. It just isn't always recognized because normally those numbers are paired with the shelf, and the shelf is 50 years old. So the shelf is declining, but the Gulf of Mexico is growing. And so when you parse out the shelf versus the deep, you see that the deep is really going for it. And Chevron just sanctioned a new project. Shell just sanctioned another new project. I mean, there's still a lot of growth and opportunity in the Gulf of Mexico.
But you put in your investors presentation, the PowerPoint slide deck, that, in your opinion, there's a lot of evidence that the Permian Basin, it's basically a treadmill, or I guess what people call, it's kind of the production is kind of reaching a plateau where it's going to be very, very difficult to continue to grow production going forward. What? Because of the amount of capex and the amount of capex required to drill wells, depletion rates, and there's just not as much tier one acreage. Would you say those are the main reasons why you see this treadmill playing out in the Permian Basin?
Yeah, for me, the tier one acreage is probably I feel like the production has kind of reached critical mass. And yeah, they're going to be drilling more and more into tier twos to replace the fact that they don't have tier one anymore. There's been some technology increases, like longer laterals and whatnot that have kind of helped that. They've also changed completion designs a little bit that boost their initial production, but those designs also tend to mean that the life of the well is shorter. So in outer years, it's producing less than what it was with the previous design. Um, so yeah, I mean,
does that mean then, sorry to interrupt you again, I'll clarify this for our listeners. Does that mean then that the first couple of years of the well, it's going to free cash flow even more, but then later on it's going to produce less?
more like the first 6 months. Because again, these wells decline very rapidly. So, but this is just some preliminary information that we're starting to see. Like when you look at the decline curves that are posted by the EIA year over year, you can easily go in there and you can look at what these well profiles look like. And they come on, and within a few months, they're already in exponential decline. So what some of these new completion designs, they've been able to like really ramp up the production in the first few months, but it just falls off a cliff, toward the end faster. But whether that means it's producing 18 barrels a day versus 20 barrels a day, like I don't have enough information to kind of to say that, but really it's kind of the tier one versus the tier two. And it's also access to people. There's like I said, I just feel like we're at critical mass, and like for next year, like one of the things that is also kind of weighing on the oil prices and probably prompt OPEC to extend their cuts was that one of the assumptions for next year coming out of the IEA is that the US will add another 600,000 barrels per day to its daily production. And I don't see that occurring. But, like we'll see. We'll see. Because I feel like the US really goosed its production this year. And I would lean more toward maybe the US being flat than or even down than I would lean toward it being up, just based off of what happened with the rig count this year.
Is there a lot of drilled but uncompleted wells that could be brought online quickly, or not as many as in the past?
No. So the DUCs, let me find that information. So the DUCs kind of peaked in 2020, and they peaked around 8,000 DUCs. And then now we've declined down to less than 3,000. And even though that sounds like a lot of DUCs, the reality is some of those wells aren't good. So we're always going to have like a DUC reserve that is kind of slush. Maybe 1,000 of those or whatever are not good wells that'll never be turned on. And then there's always a certain number of DUCs that are just kind of in transition. So maybe they were drilled, but they're going to get flipped on a few months later. And I feel like we're kind of getting to these levels where there's just not a lot of excess inventory that you would be able to meaningfully scale production without adding a whole lot of rigs. So unless we see, a 20% increase in rig count in the Permian Basin, I wouldn't expect to see any increase in production. And actually where we are right now, I would expect us to see declines in production over the next year. you
Well,
know, but
isn't the rig count, it's down over around 20% since November 2022. So, and it looks like it could be trending even further downward.
well, so rig count does tend to fall toward the end of the year because companies their annual budgets get exhausted, and so they just can't keep those rigs going. And then I do believe that as soon as the calendar year rolls over, I believe next quarter we're going to start seeing rigs getting picked up again. And there tends to be like a 3 to 6 month lag on drilling to seeing any changes, in production. And that those 20% of rigs that were dropped last year, you know, it'll take 6 months to a year just to pick those back up again. If the industry wanted to, if they had the appetite to. So, but I definitely feel like they'll be picking back up rigs. I feel like way too many rigs were dropped this year. And especially with the reduction in the duck count, they've got to pick back up because no company, like sure, it's great to show that your production is growing. The investment community is happy if you're flat, but you will become rapidly out of favor if your production is declining. So these companies that have dropped rigs or have slowed down their rig program over the last 6 months, they will have to pick back up.
So are we at like a West Texas intermediate crude price where the break-even cost to drilling and completing new wells, where these oil producers can still make a good profit, or are we close to production costs then?
So that's kind of yet to be seen. So the break-even prices have been climbing. The last estimates that I saw, the break-even prices for the Permian are probably like in the $50 to $60 per barrel range. The problem with that range is I don't know how much of that might have some discounts in it from completing ducts that were drilled in prior years. But that said, like let's say it's $60 per barrel. When oil was pulling down to $68 a barrel, it's not like anyone has a huge appetite to go chase after it. The Dallas Fed survey that was completed in the second quarter of 2023, the majority of respondents believed that costs were going to be continuing to climb.
Well, yeah, look at inflation, the higher interest rates. I mean, there's a lot of industries, they want higher wages. So, I mean, there's all these input costs. Even if a few of them go down, I think a lot of these input costs like labor and interest rates, these things are going to start causing higher input costs for a lot of companies.
Yeah.
Do you see, I know, do you see, since you work in the oil industry, do you see any input costs that are falling lately, that are falling rapidly?
I mean, I'm not really close enough to it right now to speculate on what portions of the supply chain might be falling. I mean, obviously anything that you can help digitize, would fall. Like whenever I was still working in the industry, a lot of firms were starting to outsource their accounting departments because that was something that would be cheaper for them to let an accounting firm outside the organization to run. And then inside, we just had a smaller number, right, doing that portion. So, but there's still a lot of skills that are specialized to the oil and gas industry that are never going to be, never going to be outsized, per se, except maybe to, like an oil field service company. So it doesn't necessarily happen a lot in the US, but in a lot of developing countries, they have, there's a lot of agreements where it's like someone will hold that acreage and they'll hire Schlumberger or Halliburton or somebody who's got a reservoir management group to actually go in and do all of the technical work for them, and then basically, deliver them the wells on production, versus here in the US, these companies, they have all their own technical teams and they're doing that themselves. So.
And you mentioned the Dallas Fed survey of energy producers that they don't see costs falling
So
at least.
70% of the respondents didn't see costs falling. So that was like there was and as we move into the year and more people are announcing their forward budgets. I know recently there was an article that came out. I want to say it was Evercore ISI that published it. Let me see. I'm trying to find it because it's in my notes. Yeah, so basically Evercore ISI, they're projecting that for 2024, there's just a nominal increase of 2% in capital spending in the US compared to a 19% increase that occurred in 2023. And that for the first time ever, you'll see uh countries outside the US growing at a faster pace. And, but that said, it's only expected to be globally 5%. So, but as the costs have increased in the shale, it makes other basins outside of the US, more competitive for capital. And so that's what we're starting to see is that there'll be a little inflection there. So especially if we're running out of tier one acreage, it's like, hey, why drill yourselves out of a job, which is kind of what the Permian's been hell bent on doing for the last decade.
So your thesis is that the Permian Basin is kind of plateauing. It's going to be stuck in a treadmill where there's some production growth and then it falls back. And then maybe it goes into production growth. Maybe it depends on oil prices and interest rates, or if one of the oil service companies or drillers starts giving a discount for more drilling. So it kind of sounds like a trading range for production growth where it's not consistent production growth because all the easy targets, tier one acreage, where they could easily grow oil production, that's kind of gone then.
Yeah, for this next year, I expect to see the Permian flat. Now, if it grows like what's in the IEA forecast, then I was wrong, and I'm sure next year I'll be calling for it to be flat. But it's going to flatten out eventually. It's going to flatten out eventually, and I just keep watching and looking for it. So, and I think that these private companies taking the opportunity to sell themselves, I think that they also see the flattening coming. And even Pioneer, selling itself. I mean, I think that these are signals that the Permian is topping. So they're getting out while the getting's good.
Well, also interest rates and cost of capital. I mean, some of the smaller companies, their cost of capital is going to be way higher than ExxonMobil or Chevron, who have much cheaper cost of capital. I mean, ExxonMobil, because they paid off a lot of their debt, if they wanted to, they could go borrow at much lower rates than a lot of these other oil companies.
Well, I mean, it just depends. I mean, a lot of these shale wells, I mean, they're cheap, low-tech wells. You don't need a fully automated rig with all the bells and whistles. So I wouldn't necessarily believe that that they aren't being efficient in their spending. Let's just say that. So I think a small company can be just as efficient, if not more so, than a major with a master service agreement. Because the small company who only needs to drill a few wells, sometimes they're able to pick up their gear like in the lull periods and negotiate, really great terms because they're only active, in the slow periods or when there's a lag on gear and they kind of fill the gap. So yeah, I wouldn't discount the small mom and pops.
There's a lot of good Canadian companies that are undervalued, like that Canadian oil producers, and they've been buying up US ones too, I think recently in the last like 6 to 12 months. Where do you think the oil production growth is going to come from if the Permian Basin does stay in this treadmill for a while?
So right now, the countries that are expected to increase their production next year behind the US, which I don't believe, is the first company up, or the country up is Brazil, which I do believe. They've got an aggressive FPSO rollout schedule where they're rolling out an FPSO and turning on more wells every year. And so I do believe that Brazil might end up being the top country for production growth. Canada is supposed to have a small increase. China is even supposed to have a small increase. Argentina, but these are very, very small numbers. Really, when you think about who might fill the gap, it's not so much non-OPEC countries as they are OPEC countries. So OPEC right now is producing 4 million barrels a day, less than what they were in January 2020. Now, that doesn't mean that I think that they have 4 million barrels per day of spare capacity. I think their spare capacity number might be somewhere, it might be half of that, or even only 25% of that. But if there starts to be supply weakness, and if the price of oil starts climbing, I would expect to see OPEC start to bring more production in the market to try to keep the market balanced around $85 a barrel, which is really kind of the everybody's happy sweet spot. At $85 a barrel, almost everybody is profitable, and OPEC countries are able to balance their budgets, and it's kind of like this win-win scenario, for oil. I would
It's
love
also
that scenario.
85 to 85, 90, $95 a barrel is also not destroying demand for a lot of consumers.
Yeah. Yeah. And well, although I think 85 is a lot more palatable than 95. I mean, I think governments start getting really squirrely when oil starts approaching $100. So I like that 8 handle in front of the price of oil, because I feel like people are really comfortable there. And I think they, like I said, as it heats up into the 90s, I just start, expecting to see more rhetoric and more public attacks, on the industry, and things that just end up being destructive in the long term.
I was
So.
interviewing Josh Young again a couple weeks ago, and I asked him if the Saudis were happy when oil was in the high 60s, and he was saying absolutely not, because with the higher costs and inflation, he was like, oil below 68 to 65, 60, high 50s. He was like, it hasn't offset any of the inflation. They can't balance their budget for their social program spending. And then with all the other higher costs, they're not generating the free cash flow. So he was saying that basically like OPEC is very unhappy if oil goes below like $70 a barrel now.
Well, and I mean, and I don't blame them. I mean, like, they have really sacrificed this last, 4 years trying to keep the global, system in balance. And the US is more or less spitting their eye to increase production to all-time highs when they're curtailed. So it's and you probably see me from time to time, tweet about this, because there's always somebody who's like, wringing their hands and vilifying OPEC, and when's OPEC going to ruin it for us all by flooding the market? And I'm just like, well, why don't we have a discussion about the greed of shale producers, and and how they're scaling too quickly. I mean, all the fluctuation is coming from U.S. shale producers.
Well, I don't think OPEC can flood the market. So, like, the only major OPEC country that I think actually increased production substantially was Iran. So, Iran increased production a lot, and that might be a one-off. I don't think it's sustainable where they can keep growing production enormously. A lot of the other OPEC plus countries, I mean, I think they're way below their quota numbers.
Well, again, it's been curtailed, by 4 million barrels a day, and that's been spread across the system, in line with their needs. But I mean, OPEC countries, I mean, they are investing in themselves. Like, when you look at the international oil rig count, you can see that the Middle Eastern rig count has been steadily increasing since COVID, since 2020, but it's still not back to where it was in 2019. Latin America their rig count looks like it actually probably exceeds where it was in 2019. Asia Pacific is also kind of in line with where they were in 2019. So, and I think that Like when you look at what's occurring in the Middle East, I mean, they've purposely restrained themselves because they see, hey, we're cutting back to balance the market. So why build up excess inventory? So
Yeah, I think at this point, I don't think OPEC really cares as much about market share as they have in the past. I think they more want to make sure that the price doesn't go too low because of all the inflation and balancing the budgets out. So I wouldn't
well,
be
I,
surprised.
I think they're playing the long game. So they understand the life cycle of an oil field. They understand that eventually the Permian will top and start to fall. And I think that they know, we can just bide our time because eventually this game is coming to our backyard anyway. I think
So
they're just more patient. They're more patient than public and private, oil companies in the US.
So for private oil production growth, and you talked about OPEC growing, is a lot of the production growth, is it going to come from deep water then once the Permian goes into more of a decline?
I mean, I think 10 years from now, the US could have a real problem. If the Permian goes into decline, where are we going to find 3 to 5 million barrels a day to offset what was coming out of the Permian a decade from now? I don't know where it's going to come from.
Well, according to the estimates, Christine, the demand is supposed to collapse and we're supposed to be driving electric vehicles by 2030.
I mean, if that's true, I don't know why Ford just cut the Lightning production for next year by half.
Oh, I was being sarcastic. I don't believe
Yeah,
that.
I know, but I'm just saying the EV, the EV adoption, it just isn't meeting expectations. I mean, EVs are the most rapidly depreciating vehicles, and the average consumer is focused on value. They're more so than buying an $80,000 car that's going to devalue 60 to 70% over the first 5 years of its life. So, the average person just can't afford that.
Well,
So
also,
I've always seen EVs to be more of a luxury vehicle.
yep.
That's it's more about status, but like that's not the American mainstream consumer. There's a reason why the Toyota Prius is like the number one vehicle. It was rated the number one vehicle this year. I mean, believe it or not, the
Oh,
Prius. And
is
it's
that the
because
hybrid?
it
Is
gets
that
like
the hybrid?
60 miles a gallon. I mean, the average consumer is like, hey, I want the best value for my buck I can possibly get. Toyota Prius.
Yeah, so like the government elites are all saying that like, oh, fossil fuel demand is going to collapse. We're going to transition rapidly to electric vehicles. I mean, the infrastructure is not in place. They keep passing these infrastructure deals. The infrastructure spending trillions of dollars. I mean, there's not enough charging stations. I do see a lot of electric vehicles around here, but they're mostly by rich people. And then when I see like the pickup trucks, like the Rivian one pickup truck or some of the more expensive electric vehicles, I mean, they're not by like construction company, independent contractor, small business owners. So it's not like they have anything in the pickup truck. It's like an empty electric vehicle pickup truck that they virtue signal to pay to show like, oh, hey, I can afford this and afford to plug it in. The average small business owner who needs a pickup truck is not buying a Rivian pickup truck.
Well, of course, I'm an Okie, and when I grew up, we used to talk about J.C. Penney cowboys. And a lot of people probably aren't familiar with J.C. Penney because it's basically a retail store that's also fallen off a cliff. But there were real cowboys that were wearing Wrangler jeans that they probably bought from Oklahoma from Walmart or from a like a feed store and Carhartt jackets and whatnot. And then there were the J.C. Penney cowboys who would go buy, the fancier cowboy attire, but probably never actually stepped in, on a farm or on a ranch. And so when Ford rolled out the Lightning, I just kind of thought like this is the same thing. It's like you've got the real workers who need a truck, who have a truck because they need to haul things. And then you've got the the buyers of the Lightning who just want to look tough in a truck. But they actually probably never use the truck bed for anything. Their truck is probably always clean.
Well, it'll destroy the battery too. I mean, like you're not going to get the range. You start putting the heavy stuff in there and you start plugging things in. I mean, you put like a diesel generator or something else that you're doing work on. I mean, the battery range is going to be destroyed.
Yeah. Yeah. But anyway, like I said, the consumer has spoken, right? They're reducing, they're dialing back their production plans. Other EV producers are also dialing back their production plans. In 2021 and in 2022, Toyota was getting chastised because they were more focused on hybrids and plug-in hybrids than they were on EVs. And then now when you look at some of the most popular vehicles in the US and the vehicles who most hold their value, Toyota has multiple vehicles on those lists. So obviously the Japanese, they're focused on the right factors. So
yeah, I think we're going to see electric vehicle sales until the infrastructure problem or the costs come down and you're getting a higher quality vehicle at a lower price. There's just not going to be as much demand as people expect, especially for these pickup trucks and stuff. Because if you need to actually haul things and do work or run your construction company or landscaping business out of it, I mean, you're not going to use an electric vehicle. The electric vehicle pickup trucks I see around here, they're all empty. There's nothing in the pickup bed.
I mean, I think EVs are great for white collar workers and for soccer moms, people who are just commuting, 5 to 10 miles, to and from their home, like doing routine tasks. But like I said, it's not, because of the fact that the battery efficiency gets so poor as the vehicle gets weighted down. I mean, we really just can't. You're just not going to see EVs taking over in the commercial sector. Now, I do know that the U.S. military is starting to do a lot more of their vehicles as hybrids. But again, I mean, hybrids make sense. They're you always have the gas. Yeah, they're more efficient, and you always have the gas option. And when electric is available, if you've got the plug-in hybrid, then why not use it? Why not offset your gas costs? So I think we're slowly going to see the hybrid segment, grow and grow and grow. And that also works for rare minerals because hybrids require much less rare minerals than EVs do. So they just work. They just work. And as vehicles get more fuel efficient, and with hybrids, that also reduces the desirability of the 100% EV.
So as we wrap up the interview here, obviously I was teasing it at the beginning. We've gotten a lot of questions from patrons about Guyana, about what's going on there. The Venezuelan military has threatened action, invading potentially Guyana, because what the Venezuelan Orinoco oil belt there, it goes into Guyana, into their deep water after a lot of drilling, I think, as you talked about in the last interview. So what is your view here on the Venezuelan military going into Guyana?
So I feel like what's occurring is nothing more than saber rattling in order for Maduro to shore up, his base to try to win an election. So, and there's a number of factors that support that. So first of all, like the same week that he released the map stating that the Guyana Essequibo was officially part of Venezuela, that same week, he went out and arrested some of his political opponents. A lot of people don't realize that Guyana is actually vastly undeveloped. I mean, it's jungle and mountain, and the roads like really aren't there yet. And what roads do exist are deeply rutted. They're muddy. It's super hard to drag equipment across. And so if Venezuela wanted to invade Guyana, they actually can't do so from their adjacent border. They would actually have to hike into or traverse into Brazil first, and then come down into Guyana from the Brazil side. And the president of Brazil has already told Maduro, "You're not putting your troops, in Brazil."
Well,
So that's a no-go.
there's a
And the US has sent their military presence to Guyana as a show of force and solidarity with Guyana that we have your back. And trust me, if Venezuela tried to send their navy over to an Exxon FPSO, there would immediately be a US response. I mean, it's not in my like I would you could just like it's like I'm like 99% confident it's not going to happen. I would be shocked. I'd be shocked. And if it did happen, I would think that somebody was probably uh in Maduro's ear, potentially from Russia, asking them to do that just to create more, unrest in the world. But I don't think
that
that
would backfire.
anyone in the Latin American community is backing Venezuela or is standing with Venezuela like on these unrighteous claims.
Well,
And just last week, the president of Venezuela, Maduro, met with the president of Guyana. His name is Ali, and they met in one of the Caribbean islands. I can't remember which. And I mean, they shook hands and they agreed that their conflict is going to be resolved in a peaceful manner, and there will be no force used. So
well, things would go out of hand pretty quickly, I think, if Venezuela did decide to do military action. It sounds like on land, though, that they'd, like you said, they'd have to go into Brazil, but then Brazil would be opening itself up to U.S. sanctions, and for Brazil, that would be a no-no then, because Brazil doesn't want to develop the ire from the Pentagon or DC here and start getting sanctions for getting involved in this. So Brazil is, of course, going to say no. They don't want to have troops there, foreign troops there, and then they don't want the U.S. to start putting sanctions on them for allowing that. And then if they do, Venezuela does try naval actions, I mean, the U.S. will probably send aircraft carriers in to protect ExxonMobil and Chevron, who are making, many billions of dollars of investments there.
yeah, I mean, it's the U.S. The ambassador. I mean, they've got a steady presence down in Guyana. So do the Canadian ambassadors and the European ambassadors. I mean, right now the majority of the world is trying to strengthen their trade agreements with Guyana, and they're trying to build business in Guyana. So the worst thing that Venezuela can actually do for itself on the global stage is exactly what they're doing. They really just look like the spoiled child who is jealous that somebody got something that they didn't want. And it's just a shame that the whole thing is even occurring, because really we should all be so happy for Guyana and so happy for the people of Guyana, because it was one of the poorest nations, and because they have found oil, now they're finally balancing their budgets and building out their economy, and really rapidly it's going to be, it's going to become one of the top 10 oil producing countries per capita. So the riches are just going to continue to flow. I mean, they're already the only thing that's slowing down the growth is their access to the materials that they need to actually grow. So they're building out ports as quickly as they can build out ports, but they still have issues getting aggregate in the country to actually build out roads and whatnot, and access to people and training people, because the local population, I mean, it's not that big, and they again, they were a poor nation. So there's a learning curve, there's facilities and training programs that have to be put down there in order to bring these people up to speed. And it's happening, but it still takes years to happen.
Yeah, it'll
So,
probably take a decade to install all the infrastructure and train a lot of the employees before they get a more developed oil industry. Although you're probably going to have people from Colombia. Those are like Venezuelan expats, because a lot of the Venezuelan oil workers, they've already left a long time ago for for Colombia, Brazil, the United States. They've left Venezuela a long time ago.
oh yeah. I think anyone who could get out probably did get out. So, and then even when you go to Colombia, which I did last year, it's like you see a lot of people there like living under bridges. And the taxi driver told me that those people were Venezuelans. So I mean, Venezuelans, everyone who could is pushed out, and trying to find opportunity in other nations.
Well, I think Brazil shut down the border there with Venezuela because there was so many people trying to flee. But like Hugo Chavez and now Maduro, I mean, and their cronies in the government, the bureaucrats and the military with their corruption. There's a good documentary. I sent it to you a couple days ago from Real Vision about the corruption in the Venezuelan economy and how so much of their oil wealth was stolen by the elites. And then it was bought. I think a lot of the barrels of oil and gasoline were bought for literally pennies on the dollar because they discounted oil so cheaply and gasoline so cheaply. And then the military convoys just drove the full oil tankers across the border to Colombia or Brazil to sell at market prices. And that was going on for since Hugo Chavez was in office.
Mm-hmm. Yeah, I mean, it's painful. It's painful what occurs to people who are unfortunate enough to be born in countries where they're abused by their own leadership.
So these stocks of the companies that are doing deep water offshore Guyana, then there's been a negative reaction there. I mean, I'm getting tons of answers like, should I sell my Hess oil stock? Should I dump my Chevron or ExxonMobil? Is Venezuela actually going to seize all this? You think then that their reaction then for a lot of this geopolitical risk is way overblown then?
I mean, correct. I mean, so Chevron has one of the deepest, most comprehensive due diligence processes out there. I don't know if anyone is more rigorous in their due diligence prior to doing a major deal than Chevron is. Chevron was quite happy to reach out and purchase Hess. It like not even a month before all of this saber rattling started occurring. And then even with all the saber rattling, like Chevron has pretty much stayed firm. There's not been any hints that they're going to back out of that deal. So I think all of this stuff will blow over when, by the time the election occurs. I mean, it's already dampening down because just like I said last week, there's been statements from both sides that they're not going to use force. So, and I don't think that there's going to be any court that's going to side with Venezuela on their claims of Guyana territory. And then even when you look at the maps of what they're claiming, I mean, the offshore portion stretches all the way into Suriname. I mean, it's just laughable. It's just laughable. But that's what happens around elections. I mean, like, who are we in the US to because we have our own you know idiot rhetoric and things, bold statements being made around all of our elections. So
Well, also fights over land and natural resources by governments or whichever party or dictator or whichever group is in power of a group of people or a country or a nation state. I mean, it's as old as time.
mhm. Yeah, definitely. I mean, it's happening every few years. So, and
Well,
then
but
and
the
then right now, I mean, obviously with everything happening with Russia, Ukraine, and with China, Taiwan, and with Israel and Palestine, it's almost like no better time in the world, right, to do some saber rattling now because like we're almost so inundated with it that no one's even like no one's even surprised about it anymore, you know. But I kind of made the analogy when people were first talking about Venezuela redrawing these maps and saying that they own Guyana. I was like, yeah, let me know when Mexico redraws their map and they seize back Texas. I'm like something doesn't occur just because you release a map.
yeah, I mean, I
You know,
wouldn't want to.
like either court has to an international court would have to side with that decision, or they would have to use military force. And they've got a weak military, although Guyana pretty much has no military. Like Guyana would need someone else to protect them, like in a military dispute. But
Well, since ExxonMobil and Chevron are investing heavily, I would surmise that the U.S. military, the Pentagon and D.C., since they do care about oil and I'm sure they're aware that the Permian Basin will start to slow down. They do want to secure oil resources, and two of our largest oil companies are heavily investing in there. They would probably have no problem sending a few aircraft carriers in.
Yeah. Well, and it's not just Exxon, it's not just American companies. CNOC, Chinese National Oil Company, owns 30% of Staybrook. So the Chinese are also there backing up Guyana and are also wanting things to stay status quo. They would not want Venezuela to come in there and disrupt that and try to seize it and take it over because there's no way there's no way that Venezuela has the acumen, the competency, like they couldn't do a fraction of what is occurring in Guyana on their own. That's happening because you have Exxon, like a world leader in deep water, high pressure, like spearheading these projects.
Yeah, the personnel in the Venezuelan oil industry, it's been decimated since Hugo Chavez took power. I mean, I've heard stories, a lot of the Venezuelan oil workers, the most competent ones, the quality ones, they've left the country. So they're working in the United States. They're working in other countries. They're not in Venezuela anymore, the best oil workers.
Well, and even Venezuelan oil production, I mean, it's not like Venezuela's oil production. So Venezuela is heavy crude, low pressure heavy crudes, and Guyana is high pressure light oil. So they don't even have transferable skill sets. So
Well, the average person is not talking about that. So for some of these maybe small caps that are drilling in Guyana that you were talking about on the last interview, do you think some of these shares have sold off a lot and there's good risk reward value opportunity now?
So, I do, but I also agree with the sell-off. So kind of what's happened there is, so the small companies are Frontera Energy and CGX Energy. So last year they had a discovery in the quarantine license, which is pretty much between the Stabroek license and Block 58 in Suriname. But they didn't acquire enough information on that well to really drive a deal home at a high valuation. But they had enough information that they were confident that a lot of oil existed on that block. And so they had the hunger to take on the risk of drilling a second high cost, high profile well, which was the Way-1 well that they drilled at the beginning of this year. And halfway down, they, like in the shallower zones, they ended up encountering oil-bearing zones in the Maastrichtian, which is the same formation that Exxon is producing from in the Stabroek block. They didn't expect that. They actually thought that the Maastrichtian was going to contain gas. So oil ended up being like a huge surprise, a happy surprise, to the group. And they were more rigorous in their logging and in their data sampling on Way because they didn't want the same thing to happen to them that happened in Kawa, where they didn't get enough information. And unfortunately, halfway through the well, they got a wireline tool stuck. They couldn't get it out, and that caused them to have to sidetrack that well, which drove up the well cost. And then when they got down to the bottom of the hole, they only had one of these formation sampling tools left in country. And when they went to run it, it didn't work. The backup tool was the tool that had been stuck. And Schlumberger, who was the logging company, told them, we can't get you another tool for multiple weeks. Well, these type of wells, you really can't leave it just sitting open for multiple weeks because the quality of the hole deteriorates. And so they made the decision that they had enough data and they would go ahead and abandon it, per their program, because you typically permanently abandon exploration wells, like especially the first exploration well, like on a new prospect, which this was. And then they released the results to the market that they had close to 80 feet of hydrocarbon encountered in the shallower zones and 210 feet in the Santonian, which is the deep zones, which was the primary target for that reservoir. And I mean, 210 feet. I mean, the market heard that, and like even myself, like I was like salivating. I'm like, oh my God, 210 feet. I'm like that pay zone is going to be huge. And then it's like 6 months later, they had their lab results back because a lot of the samples that they had acquired from their wireline runs, they sent them out to lab analysis. So once they got all their lab analysis back, then they updated the results from the Santonian, telling the market, well, it's not effectively 210 feet. It's really only 40 feet because the clay content down there was so high that it's not permeable and it's not likely to flow. And so the investment community, heard that, and the stock is sold off. Now, that doesn't mean that the license doesn't hold value, because when they did their technical update a few weeks ago, they said that in that upper zone, the Maastrichtian over their license, they feel like there could be 500 to 600 million barrels that would be a standalone development. But, in that presentation, it was a technical presentation, so it probably wasn't super compelling to the average investor. But really, who that presentation is geared for is for companies that might be interested in acquiring them. So that's kind of what everyone who still holds the stock is waiting for. That JV has hired Houlihan Lokey, which is a private equity company, I think based out of Houston, but they've got, locations in other major cities. But that firm has actually done like the most deals in the industry this past year. And I don't think they would have taken on the role of trying to sell this asset if they didn't think that they could get a deal across the line. So that's who's working it now, kind of as a middleman. And if a deal is announced, we're going to see a major reversal on these shares, and the share price is going to go up. But I feel like in the near term, they're probably just going to continue to trade sideways, because the thing is you can't tell the investment community 210 feet and then reverse it down to 40 without losing a whole lot of confidence. I mean, especially on a thinly traded stock. And so that's what we're suffering from right now. They made a huge mistake on that first press release. I think they were too optimistic, because I think that they might have had some indications of high clay content, like when they put out that first press release, but they chose to do so. And then when the lab data came back, it just was confirmation that, that they're going to have to walk back some of those results. So it's been a huge disappointment, to me, because I feel like the sell-off could have been avoided if they had only chosen better words, but they didn't.
Well, a lot of these small companies, and it happens this way in mining too, they announce drill hole results, and a lot of these things are biased and skewed. Some of these mining companies, the smaller ones, when they think they have a mine, I mean, they'll put all these way optimistic projections into the feasibility study that have high metals prices or lower construction costs, and then once the feasibility study is redone by a larger miner, then you realize that the mine isn't as economic. Do you think, though, that this is like a balance sheet or funding issue, that maybe like some of that oil with the clay, can that be developed, or is that like a no-go now and they were just way too optimistic and they're going to scrap that project and focus on the other project that you said that they could sell?
Yeah, I mean, like based off of the results that they released, I don't think that anybody would be potentially drilling deep into the Santonian for years and years. I think that they would focus on the low-hanging fruit, which is the easier to drill shallow formations in the Maastrichtian that are like Stabroek. And Exxon is like literally drilling two wells, within 10 miles of these two wells, like right now. Like they've got a prospect called Bluefin that might even extend into the quarantine license that they're drilling, and that well probably won't be done until February or March of next year. And then they drilled an appraisal well on a prospect called Hymara that is just north by a few miles of Kawa. So, I mean, so Exxon's clearly still interested in this area and would be a potential buyer of these assets, just like Total might. And then actually now that Chevron is buying Hess, so Chevron also has the block to the west. So they would be partnered in the block to the north, and then they would also be the operator in the block to the west. So I mean, so we'll just have to see. I mean, I'm holding my shares. I'm trying to be patient, although it's really hard because, like I said, I was super frustrated with the PR this year. I thought it was pathetic.
Yeah,
So and I'm still kind of deeply aggravated. You could probably hear it in my voice, like I'm like clenching my teeth.
Well,
I'm like these assholes.
the small cap oil stock tricks, some of those things better than I do, but I know the mining companies, the smaller ones with the drill hole results. I mean, I don't even pay attention for a lot of these smaller miners until there's a feasibility study out, and then now you're seeing the feasibility study redone with higher production costs and the interest rates, higher cost of capital, metals prices change. So they're redoing their feasibility study. So all of a sudden, what they thought was an economic mine, a year, 2 years, 3 years ago, now the costs are higher, metals prices are flat. The mine's not economic anymore, especially if you're going to borrow a bunch of debt to build the mine. So,
Well, so actually this group had been conservative on their preliminary results for Kawa. And then after they got the third party analysis, they ended up revising up the numbers. And then even for the shallower results, those results also got revised up on the after the third party analysis came in. And it's just this deep Santonian which appears to have been sandbagged. So I wasn't expecting it, and I don't know, at the end of the day who's responsible for it, but I feel like it was a serious mistake that was made at the time, because I feel like their geological department should have been a lot more cautious based off of the samples that were received, the mud logging while drilling, and then even the real-time data and the wireline data that they would have had in hand whenever they released that statement. But you know hindsight's 2020, and clearly once the third party work came in, they realized that they had to correct that. So it's been painful, but hopefully Houlihan Lockley will get a deal, and here in the next few months, and I'll be happy to walk away with a gain at that time. But right now I'm definitely down on my CGX Energy shares. I mean, they're trading at a lower valuation right now than what they were before they had two discoveries. And I'm pretty much flat on Frontera Energy. And Frontera Energy is the safer way to play this partnership, because they do have production in Colombia, so they have free cash flow. They have a port in Colombia, in Cartagena, that actually just connected pipelines to an Ecopetrol refinery. So they should start getting more revenues through that pipeline. And they have other midstream pipeline in the company. And because their stock has sold off so much, I think it's sold off like 20% since the snafu with the Guyana well results. They announced that they were going to buy back 10% of their stock. So it's a safer way to play it. If people want to dabble in there, it's, I feel like that the floor is kind of in, and it should be up from here. And whether it goes up 25% or 100% will be based off of whether or not they can get a deal on farming down their high working interest in the block in Guyana.
So in terms of companies that could buy it, is this a project that only like ExxonMobil or Chevron, some of the larger super majors, or could some of the sizable independents or mid-tier, say in Apache likes investing in different deep water projects, or ConocoPhillips, would they be interested? So there would be more bidders than normal, just a couple super majors.
So Apache is partnered in Block 58 next door with Suriname. I don't know whether or not they would have the appetite to take on this acreage as operator, because Apache already kind of struggles from high debt that they're trying to pay down. So I don't know how much flexibility their board would give them, for taking on an operatorship role, especially after they farm down their operatorship to Total. I could definitely see them coming in as part of the JV. So, like, let's say, they came in as a Total, Apache JV, or came in as a Chevron Total JV, like that.
Okay,
I
so
would
they
almost,
split. Okay,
I
so
would
I see.
almost
So they,
bet that a JV will do the deal. That we,
oh,
I don't think we're going to get just one partner. Like, I think we're going to get like a consortium buying in, because that's how these big companies are liking to do these big deals. On especially on exploration, in undeveloped assets. Like, they're wanting to show up with a buddy, because that shows right off the bat they're diversifying their risk.
okay, that makes sense. I was going to say that if the joint venture, for our listeners out there, a JV is a joint venture, so they'd be splitting it. They'd be splitting the exploration drilling costs, the development costs. So I don't know. I don't know what the
Yeah, the
percentages would
technical
be.
work. I mean, even when you look at activity in recent lease sales, you see that there's partnerships going in, and they're purchasing blocks in these lease sales, versus someone going out and getting that block on their own, like in these emerging basins.
So,
So
Frontera and CGX, their cash, their balance sheet, can they wait this out for 6 months, 12 months, 18 months to get a better price? Or are they hemorrhaging cash and have some balance sheet and cash flow problems and where they're going to be forced to do a bad deal?
So Frontera can wait longer than CGX can. So CGX, any forward activity, I mean, is going to be contingent on a deal. And Frontera owns 77% of CGX stock. So really everything's going to be driven by Frontera. But Frontera is also under a lot of pressure from their own shareholders to get a deal done. So I don't think that at this point in time they're gonna wait. Like, I think that they've kind of already slow walked this as long as they possibly could, getting all their third party data into place, and hiring Houlihan. And I think now that the information is slowly being passed over to the interested parties, and those parties are going to run their numbers, and hopefully we'll see a deal in Q1, hopefully.
Well, I
So
think we're going to see a lot more mergers and acquisitions at current prices for the entire industry.
yeah. Yeah, and I mean, like I said, this is, these barrels have been de-risked by these two small companies. There's value in the work that they've performed. So the market currently isn't valuing it, but these two stocks also don't tend to trade logically, because they're thinly traded companies, operating in an emerging country. So it's an investment that's not for the risk adverse.
Well,
So let's just say that. But I again, I still hold my position, and I'm trying to be patient. But it's recently been frustrating, because of the PR snafu. So
and the geopolitical risk headline. So even though we've addressed this over the last 20 or 30 minutes, that there probably isn't the geopolitical risk that the market thinks, that a lot of people are panicking. So the algorithms are going to see all the headlines and they're going to sell the shares short.
yeah, but actually, when you look at the location of these two companies' license, it's outside of the area that uh, Venezuela claims they own. So, but again, most people don't look at maps. Just
Oh,
like you said,
these
it's the
algorithms
headline.
don't care about facts.
Yeah.
These algorithms, these stupid trading algorithms literally just trade on headlines. They're not going to look at facts like that.
Yeah. Well, I mean, just look at the IEA, right? I mean, they're saying that the US is going to bring on an extra 600,000 barrels a day. And at the same time, we're also assuming that CapEx is flat. So how does that happen? You can't bring on new barrels without more spend.
Yeah, and both of those assumptions may not be true. I mean, like, we'll see how much capex is spent, and they're assuming this magical production growth, and they're assuming that OPEC has spare capacity. So there's a lot of and then global oil inventories are not at the high levels. So even if the U.S. has a slight inventory or supply glut relative to the rest of the world, I mean, it's not very much.
Yeah, it's actually interesting when you talk about the global inventories because everyone is comparing the global inventories to what the inventories were last year. But last year, the inventories were at the bottom of the 5-year range. When you compare our current inventories to the 5-year range, our inventories are actually less than the 5-year average.
So that's global. Is that U.S. or globally that you're
That's
talking about?
that's OECD stocks. OECD commercial stocks. That's global stocks. But the market right now is more focused on the fact that this year is higher than last year, more so than comparing it to a 5-year range, which normally you're comparing it to the 5-year range.
Well, also there's a lot, we have record amounts of net shorts on oil futures contracts. I mean, we're at 2020 pandemic levels of short sellers on futures contracts now at these levels.
We're actually less than. Like it's even worse. It's even worse. Like we've got even more shorts right now than during the March COVID crash. It's
Wow.
crazy. It's crazy.
Normally in my experience, when a trade is overcrowded, especially the short-term hedge fund managers, because a lot of them are good at marketing and sales and can't generate alpha. I mean, normally when the boat is crowded to one side, the trade reverses. So we'll see what it doesn't happen immediately, but over a couple months or a couple quarters, these things will reverse. So we'll see what happens.
Hey, I'm all about a rip your face off rally. And then also when we look at what typical crude oil future seasonality looks like, as we come into the next year, like if you look at historically what's happened, you would expect crude oil to be somewhat flat going into the beginning of the year, but in February start to increase through the middle of summer. So, I mean, we're well positioned right now for a rally, based off of so many different signals and trends.
Yep, and we're at the bottom end of the trading range because for the last like 12 to 18 months, oil has been kind of range bound between around 65 on the low end and around 95. So it's been kind of in a trading range for the last 18 or so months, give or take.
Yeah, and really the only thing that bears have going for them is the fact that OPEC at any given time could ease their cuts. So that's the one thing that's being used right now to instill fear in investors. But we've got 4 years of watching this group um, execute discipline, and I wouldn't expect them, and like I said earlier, I wouldn't expect them to start easing their production cuts until oil's stabilizing, at $85.
Well, actually, that's not what the hedge funds that are short oil are telling me. They're telling me there's a supply glut with inventories here in the United States, and they're predicting demand to collapse globally. So that's
Yeah.
what they're
Well,
predicting. So,
supply glut compared to 2022, but still below the 5-year average.
oh, they don't want it. They don't want to hear that. And then when they're shorts, when they got short squeezed, 8 months ago, they didn't talk about their losses when they got blown out in their shorts.
Yeah, but that's also why we have to get together and have all these discussions so that, everyone's able to actually build a complete picture. So that's what makes a market, right?
Yep.
You can't listen to what the pundits are telling you. So it's always check and verify.
Well, also there a lot of these guys are managing a lot of money. So in the short term, they can knock the price down temporarily, but then there's going to be less supply. I mean, with interest rates and oil prices at these levels, there's not a lot of incentive to bring on a lot of new supply in the short term.
Mhm.
So we'll have a rally, and then we'll see what happens with the trading range. I want to thank you so much for your time today, Christine. I kept you for around 90 minutes, but I think our listeners will get a lot out of this discussion. My listeners want to follow you on Twitter or take a look at your work. How do they do so?
So I'm She Drills on Twitter, and just be careful and make sure that you verify the ticker name is She Drills. My last name is Guerrero, Christine Guerrero. But I just say to verify it because this year I've had like a new troll account, like an imposter account almost every month. So it's like I'm always got somebody pinging me. Oh, you've got another imposter now. So
Are they selling crypto? Crypto trading
I think
program?
so. So I mean, they're getting really smart at what they do. It's like they create their account, they use your image, they use your name, they use a ticker name that's very close to your ticker name, except maybe they'll just change like an L to an I or number one or something like that. So it still kind of looks like it, and then they'll replicate like all your tweets. And then they'll start reaching out to your followers and following them to get them to follow them back. And
Yep.
and then usually after someone follows them back, they'll kind of strike up a conversation,
They'll
and then
slide
yeah,
into
they
the
try to
direct
sell them
messages.
crypto. I mean, it's disgusting.
They'll slide into the direct messages. Oh, hey, I haven't spoken to you in a while. Do you want to purchase my crypto trading program? But they also they block the original person. So like all your copycat Twitter accounts, they block you. So you don't know that it's going on because you're blocked
Yeah.
from the copycat accounts.
Exactly. You don't know if it's going on unless someone tells you it's going on, and then sends you a screen capture, and then you know it's there, which, like I said, I mean it's just pathetic. I mean it's just pathetic. So anyone who's listening to this, I mean, I have never charged anyone for any information, like even this presentation. Any podcast that I've done, any presentation that I've done online, like I've never been paid or compensated for that work. And I'm not a financial advisor. I'm not a portfolio manager. I'm not trying to get money from private investors. I'm really just talking about my personal investing thesis, and putting ideas out there. And I'm definitely not going to try to sell you anything. So, you can take my words at face value, and then if you think that some of my leads are interesting, then follow up and do your own due diligence. If you invest, great. If you don't, well, that's great too. So,
Exactly.
it doesn't phase me one way or the other. There's
Well,
there's thousands of opportunities on any given day, and it's up to you to chase the ones that you think will work.
well said. That's what I was going to say is people should do their own research and due diligence. There's a lot of opportunities out there. So there's companies and stocks that are hated right now that could go up a lot over the next couple of years. I mean, things are just wacky with what's going on with governments and central banks right now.
Yeah, I mean, my biggest winner for this past year was Petrobras, which ended up being up close to 50%. And that was before dividends of over 20%. And when I was investing in that, I was getting poo-pooed because everyone was saying that Petrobras was going to be socialized and you can't invest in that and blah, 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 blah. But at the same time, I was looking at their growth trends, and I'm looking at that, who owns their debt, and I'm thinking, no, this stock is going to remain a stable investment, and I jumped in. So, but just like the Brazil investment was a great investment this past year. I mean, obviously, I've been hit by what's happened, with my small cap, and their PR snafu. Although I still have some hope that I'm gonna, climb out of that ditch. And Hess, which has been a great performing company over the past 5 years, they were only up 4%, year to date. And then with Chevron acquiring them now, Chevron being a bigger company, I wouldn't expect to see Chevron moving with momentum the way that Hess was. So, I mean, Hess had like a multiple of 20 when it got acquired. I mean, Chevron's not going to have that multiple. So a lot of people that were invested in Hess, they've got their feelers out trying to figure out like what that next runner is going to be. And I think it could be APA. So, because APA is that second biggest company in Suriname, and Total in the final stages right now of sanctioning their first FPSO. And that FPSO is going to produce like 200,000 barrels a day, and APA is going to get half of that. And also the cost for that project is going to be carried by Total. So APA doesn't need to go out and find financing for it. Like the financing was already worked into their farm down deal to Total. Total is going to finance them and then get paid back through the cost oil when the project comes online. So that might be something to look out for an investor, who's looking for something with a less aggressive risk profile that still has a lot of upside.
So by APA, you mean Apache, right?
Yeah. So Apache changed their name to APA Corporation, but yeah, it's Apache.
Oh, I didn't know they changed their name. I mean, I just was that was their ticker symbol, right? It was APA anyway.
Yeah. So their ticker is APA, and they've officially changed their name from Apache to APA Corporation.
Sounds like they're virtue signaling.
Yeah, probably so.
Oh well. Thank you so much for your time. I really appreciate it.
All right, and thank you.